You know, there's things in life that I think when people invent or create or change something, I don't think they even realize the impact that they actually have long term because it's so revolutionary. The only way to fully grasp what has happened or what the individual has invented or modified is to really see how time unfolds and see the long term rippling effect of when something new is created or something first to market. Changes everything. So today, welcome back everybody. It is Rudy with NoShitsGiven.com Investments and a partly owned subsidiary of GarbageFireInvestments.com. And I welcome everybody back. Today we're going to be talking about one of the most beautiful, best inventions, creations, fruit baskets that Dorothy ran around in the woods with, called the basket known as mutual funds. One of the best inventions that Wall Street and human beings has ever created in the history of finance, numbers, and everything. Oh, you know what? Can you guys even hear me okay? I apologize. When you don't look professional, I forgot everybody doesn't take you seriously on the internet. I forgot I don't have a button here. There. I forgot when I apologize for that muffled audio. I know you have to look very professional to be taken seriously in this world. So in my personal opinion, I feel mutual funds are probably one of the most life-altering financial instruments ever created in the United States of America. Was it created in the U.S.? I don't know if mutual funds were created in the U.S., but we're going to go with it. I actually don't know the answer to that. And I'm going to explain to you really what the things that should be respected. It's like it should be an award should be won for this invention and how they pay out and how the behind-the-scene mechanics really pay the financial advisors, the brokers in the world. What goes on kind of behind the little rope in the little room with the curtain, and you can really see it. I mean, there's some second and third kind of close, runner-ups, but we're going to go with mutual funds in this video, everybody. So many of you out there go to school or go business school. They want to get a degree. They want to do something. You want to be like a financial advisor. You want to do something amazing in the world. So here's the thing, everybody. Any financial advisor that works for any brokerage firm, a bank, when you know you've made it in the world and you're at a little local branch and you're sitting in that little back corner and you got your monitor facing the other direction, nobody can see the porn you're watching all day, and you're waiting for some little grandma to walk in that back room and come talk to you about setting up your future and putting your money in a mutual fund. So that's kind of the thing. So here's the thing, everybody. I want to talk about how they work and why advisors and licensed brokers are trained, molded, and taught to sell everybody that a mutual fund is the best invention and it's the best fit for your future. Of course, only second best to annuities, everybody. Another video. So here's the thing. You have to understand how financial advisors make a living. And this is kind of the key component to the entire video that I don't think anyone really understands. When I was in business school in college, a lot of people would come up to me and they would all say one similar thing. Rudy, if I could get out of school, get a real job at a brokerage firm, all I need to do is get a handful of clients. And as long as I get those assets under management, so I'm managing their account, just get that first couple $1 million of assets under management, and I'm set for life. Because those people are going to stay with me for 30 years, and I'll make money for the next 30 years and just keep building my book of business. Okay. We're going to stop right there, everybody, because I want, some of you may already know this, which is fine, but most of you do not. And a lot of people keep asking me for videos like this. So, number one, for every $1 million under management that you have your name listed on the form as the broker or the advisor looking after the account, for every $1 million you have under management in a financial institution, the financial advisor gets what we call a 20 basis point trail. Or 20 bips, as some people call it, 0.2, whatever. Now, you need to understand what that really means in the real world on your paycheck. So if you have $1 million under management, you just started working at Garbage Fire Investments, and you got your first client, you got your first 3 clients, and each client has $1/3,000,000. So you've got your first $1 million under management, and you get your first paycheck from the Garbage Fire Investments corporate office ivory tower, and you look at your paycheck and go, what the hell is this? Because then all of a sudden you realize that you only get paid 20 basis points on assets under management. Which means to all of you, no, that's not $2,000 for every $1 million. Oh yes, it is $2,000, but here's the catch. 20 basis points of $1 million is 0.20. Or also, it's not 2%. That's where a lot of people get confused. It's 0.2%. So what happens is, for $1 million, you literally get $2,000. 1% of $1 million is obviously $10,000. So you get $2,000 on your trail. Okay, now the trail is the term used as your base pay. You're kind of that core bait, that ground floor. Now here's the next kicker. That 20 basis point trail is annual, not monthly. So now that $1 million you have under management, when you get your actual paycheck every 2 weeks, you make $2,000 divided by 52 weeks in a year. So that is your actual base pay, everybody. And now you're realizing, holy shit, that's nothing. Wait a minute. $2,000 per year divided by 12 months in a year. Wait a minute. Divided by 2 paychecks in a month, you can start running the numbers and figuring out what the actual amount per paycheck is. And then there's one more layer. That's the key to this entire video, everybody. And that layer is you only get the 20 basis point trail on assets under management. In other words, the $1 million that you're the advisor for, you have your little name on the top of the statement, if the money is in a mutual fund generating a trail. So let me explain this to everybody very carefully. If you have $1 million under management because you're brand new at Garbage Fire Investments corporate office, now only $100,000 of that money that you're managing is in a mutual fund, and the other $900,000 is in cash, CDs, a money market, I don't know, an individual bond, which is my favorite. Any of these assets, those asset classes normally do not generate the 20 basis point trail. So what happens is, even if you have $1 million under management and you want to be a successful, top tier, #1 broker at Garbage Fire Investments Incorporated, slap your face, you're only going to get that 0.2% on the 100,000 in the mutual funds. So now, as you can see, what's happening, everybody, is when you really break these numbers down, it's not as appealing as you may think. So people are saying, well, Rudy, I don't understand. I know advisors who are making fortunes and they live in these mansions and they make all this money. And that's correct. That does happen. I did have friends and colleagues that would have, for example, $1 billion under management or $500 million under management. And then of course, even if half of that is generating the 20 basis point trail, then you're looking at a lot of money. Because instead of a $1 million generating $2,000 as the base pay per year, if you go to 10 million, it generates 20,000. If you go to 100 million, it generates 200,000. If you go to $1 billion under management, just the basis point trail is going to generate $2 million a year as a base pay, not including fees, commissions, and changes to the portfolio and other miscellaneous things. So it does scale very high. There is a very large, actually, there's not even really a ceiling to it. A lot of business models like a restaurant or working retail or doing a regular job, it has economies of scales that run into glass ceilings. Because you can physically only make so many ice cream cups or so many, Starbucks coffees per day in a certain location without having to expand the location, change the labor, change the overhead. There are economies of scale that pretty much just bump into walls. Now, when you get into the financial field, this is why so much extreme or over-exaggerated wealth is created on Wall Street, because of the scalability factor. It's the same thing of why wealth is generated on YouTube or Twitch or some of these other places, because I can make a video and I'm hoping this video breaks 500 views and I can make, $10 on the video. But if this video for some reason breaks 1,000 views, it starts scaling up all the way up to 10,000 views, which I'll never hit. But if you get to higher numbers, the same amount of engineering in the video generates a higher amount of income with no additional workload. And that is the beauty, most entrepreneurship, that is the catnip of pretty much entrepreneurs. They want scalability, which is why a lot of people used to always kind of bash at me, make fun of me, saying, Rudy, why do you do mass box openings? The labor input, it has no scalability. And while I respect that, it also has a stepping stone to other greater things in the future. And sometimes you have to take things that have lower returns and don't have any scalability, or you have to work a job you don't like, or you have to work in a grocery store at Taco Bell or doing something because you're trying to build a ground floor to launch you or move you to a different sector. And that is also very important to also say, well, I'm too good for that. I don't want to do that. And it's very dangerous to have that kind of mindset or attitude, which is why, I'll be the first one to tell you guys. I've had like 16 jobs when I was younger, and I was fired from like 12 of the 16 companies. And none of it really bothers me because I learned so much. I understood how the world works. And that's invaluable. And you have to take that with you to become a successful entrepreneur. So back to the video, everybody. So when we go back and talk about these mutual funds, you know what? I just realized, I think the audio am I kind of muffled sounding? Shit, you know what? I didn't really tie. No wonder you guys are thinking I'm an idiot. I don't look like a professional advisor or someone who actually went to college. Did the audio just get real clear now? I bet everything just got real clear. Sorry about that. Now we can resume talking about professional real-world jobs. Now, when we go back to mutual funds, everybody, so now there's also kind of two main subsections of mutual funds. Actively managed funds and what we call passive funds, also known to most of you out there. Index funds are just basically a basket of stocks that follows some sort of benchmark or index or indice. And there's a lot of arguments on why on both ways. And we're not going to focus this video on that because it's too complicated. Because there's a lot of people that feel actively managed funds, you're paying fund managers, you're paying your advisor a 20 basis point trail. And really, are you really getting extra return for some rich fat cat to just move the holdings around in the fund, trying to get you more money, but you're paying 10 times the fees? That's an arguable thing for a different video. I'm not going to get into that. And then other people say, Rudy, screw it, just buy passively managed funds or index funds. Go to Vanguard, buy an ETF, do this. And okay, that's cool too. But again, all you're going to do is just follow the market up or down. And again, if that's what you want to do, then that's fun. In a 40, 50-year time horizon, if you're 30s and you retire and you're 100 years old, it probably won't matter anyway because everything's going to be way more just from inflation alone. So when we go back to people who want to go to school, they want to take all these student loans. They want to become some successful, better person for society. You want to feel like you have a purpose. You want to feel like that, when you wake up on a Monday morning, you're not miserable, and Sunday night, you're not sitting on the couch watching cartoons or TV shows, sitcoms, or Netflixing with your woman or guy, and you're just miserable because you're thinking about tomorrow is Monday. That is your instinct. You even understand why Sunday night rolls around, and most people get a case of the Mondays, as Lumberg would say in the Bobs. I don't think people even fully grasp why you feel that way. Because the only reason you actually feel that way is your subconscious telling you that something's fucking wrong. And that is your subconscious saying that you're not happy. Something is off, and you need to really analyze how you got here, why you're doing it, and is there really a bigger purpose? Am I putting up with it to get to a greater point in my life? Maybe graduating school, saving money to get out of debt and kind of start your own thing. All of those are very good reasons. But a lot of people out there are continuing to do that. Every Sunday night rolls around, and they just get miserable because they know they have a 5-day work week of garbage coming up. But the problem is, they don't do anything about it. They're still going to hit the gas station, buy some scratch-offs, grab some energy drinks, grab a pack of smokes, and they're going to bitch the whole way to work, and they're going to be miserable on the way home, and they're going to can't wait to get off work to go out at night and spend $40 on drinks, and you're going to go home miserable. And you know what? That is the cycle of life that makes you a lower socioeconomic consumer, and that makes you pretty much help propel, quite frankly, the economics of really the higher net worth people. Because you're fueling the people who make passive income, invest in those restaurants, invest in those bars, the business owners who own the gas stations, the corporate distributors distributing those scratch-offs and the flipping stupid energy drinks. And you are fueling all the other people to become very powerful and wealthy. You are pretty much helping out the wealth disparity, that digital divide between the classes. And the problem is you're not doing anything about it. And you have to do something about this stuff. It's not fun. It's a miserable thing. I worked years doing shitty jobs. I worked like 9 years waiting tables, bartending, bussing. I did years of it. And you know what I did with all the money? I bought Alpha Beta Magic cards starting in 2004. And everybody made fun of me. Well, guess what? Fucking joke's on you. So that goes back to the people who know me in real life. And here's the thing. This goes back to the college people now. Let's get back on topic because you guys know I ramble everywhere. I don't want to wrap this video up after 3 hours. I'm going to wrap it up a couple minutes. But I wanted to go back to the mutual fund conversation because a lot of people don't fully understand why do advisors and brokers only want me to buy mutual funds. It's because they have to make a living. It's not your advisor, it's not your broker's fault. These are regular people who are trying to make a regular living with a regular family, and they're mostly good people. But the problem is they're a victim to the system. That it's just the way it is. They were molded and trained a certain way, and it's not their fault, everybody. But you need to have the knowledge going into this stuff of why they're going to recommend a portfolio of different mutual funds. Now, a lot of you out there saying, well, you know what, Rudy, that's interesting. I didn't know any of that. And I was thinking about going to business school, and I was thinking about being a financial advisor. And you know what? If you want to do that route and you think you can make it, that's fine. It's not for me. It's not for most people, but some of you out there will probably do it and do well. But you have to understand, how do these people make money? It's by getting new clients and putting them in mutual funds. They need to pretty much invest clients in actively managed funds that generate the 20 basis point trail that also usually carry a front load fee, usually between as low as 1%, as much as 6%, depending on the amount of assets and the amount of capital being moved in or out. And again, there's different share classes if you want to go old school with the ABC share classes, which is a whole different video. But what I'm telling everyone is things aren't always as amazing as you may think. It's not that you go to business school and get a job working on Wall Street with this big ass fancy logo saying Garbage Fire Inc. It's not quite as good as you think. And for most people who even go to business school, take the student loans out, and do this, things don't work out as good as these people are imagining. And they end up still working in restaurants or taking retail jobs or trying to do their own thing. Because people like me wake up and say, I don't want to do this. Because at the end of the day, mutual funds are fine, but they were engineered to get people to move money into these baskets, because all these baskets of mutual funds generate income streams for the people who work in the industry. So depending on your perspective of it, you may think that's good or bad. I'm not really here to judge either way. I'm just here to tell people that is why they're pushed. That is why they work. That is why modern time investing can't stand ETFs, because they're the same thing as mutual funds or an index that just follows and there's no real fees. That's why the industry is scared of things like Robinhood. Shout out to you. You should sponsor me. Not sponsor, but you should. You know who you are. And, that's why these companies and these new startups are very threatening to an old school industry. So remember that, everybody. That is how it works. I hope you guys learned something today. That's all I have to say about mutual funds. Just understand that actively managed funds do carry higher fees. Usually it's between 1% to 2% of your money under management. Sometimes it's like 0.7, 0.8. And again, keep in mind the advisors get a kind of a base income salary based on these numbers. So no matter if it's a good or bad fund, they need you to move your money into that. It doesn't matter if it performs good or not. That's not the objective of the advisor. So I hope you guys learned something today. Don't care either way. Welcome back. I hope people have been asking me for more finance videos. Other than that, I'm really just not feeling dressing nice. I'm going to strip off and you guys have a great day.